On Wednesday, we were discussing in Chapter 7 the process that the auditor goes through in order to come up with a series of steps, which we call an audit program, but a series of steps that are going to allow the auditor to gather the evidence that they need about the control and figure out whether it's working or not. Okay, so for example, this first control, we said purchases over $5,000 require approval by the department supervisor. And remember, in this exercise, I said, I created this template and I just put steps 1 through 5. That doesn't mean there's always 5 steps. There could be 2 steps, there could be 7 steps. It just depends on what kind of control activity it is, right? In this one, we came up with 4 steps. So you brainstormed in your audit teams, and then we came together and sort of discussed what would we as the auditor have to do in order to understand whether this activity, purchases over $5,000, have to be approved by a supervisor. Is that actually happening? Bless you. Okay. So the first step is we have to think to ourselves, how often does a control like this actually happen, right? And I would argue that purchases over $5,000 are probably a regular occurrence within a lot of organizations. Okay, so this kind of activity would happen frequently during our audit period. And remember, we are auditing 2022, but we're conducting our control testing as of when? October 1st, right? So our period of audit as of now is January 1st, 2022 to October 1st, 2022. And again, I would argue that purchases over $5,000 during that 9-month period, there's probably a lot of them. So we don't have the time and resources to gather evidence about every single time for that 9-month period that they bought something over $5,000. So the first step is let's get a listing from our client of all the purchases during our audit period, again, January 1 through October 1, that were over $5,000. They give us that listing. And then we're going to, step 2, select a sample of those purchases, okay? So we would, out of that large population, we would pluck out some of them. And we would ask for the evidence for some of those. Step 3, request the actual purchasing document. And I mentioned to you that oftentimes that's called a purchase requisition. Like that's the name of the document or the record that they would use to request to buy something. So request that purchasing document from your audit client for the sample that you picked. And then step 4, inspect, right? That's one of those verbs that we talked about in Chapter 5. Inspect that purchasing document so that you can see that there was a supervisor signature on it, right? By gathering that evidence and inspecting it for that signature, you would be able to say, yes, purchases over $5,000 have been approved by a supervisor, or no, they haven't. We don't see any appropriate signatures on those purchasing documents. Are you with me? So by gathering this evidence and performing these audit procedures, you are able to form your conclusion about that specific control. And P.S., once we're done with the 3rd tab, I'll post this in Moodle. Okay, so you'll have access to this as well. The second control that it was a quick review that we did at the end of class on Wednesday. The IT system prevents unauthorized users from gaining access to the payroll application. So within the payroll process, there are not only, and in all of these processes, there are not only going to be sort of manual control activities, things that like employees actually physically perform, but there's also going to be IT related control activities, right? The IT system is preventing access to unauthorized user in this one particular program, okay? And so I mentioned to you on Wednesday, oftentimes what will happen with clients that have these kinds of IT controls, which nowadays pretty much all of them do, we would have a specific IT audit team that would come in and they would evaluate the IT system. They would be able to tell us, are they maintaining that IT system? Are time for any significant changes that have been made to it? Is that all happening? And then that IT audit team would provide us with their conclusions. about whether their IT related controls are operating effectively, okay? But that doesn't mean that we sort of wipe our hands of everything related to IT controls, because we could identify this as a significant control. It's something that has a significant impact on the payroll process. And so we want to gather some evidence about it. We gather the conclusions from our IT audit team, but then we also, number one, obtain a list of authorized users in that payroll system. We can review that to see if it seems appropriate, right? Like if Jake in the warehouse has access to the payroll system, that's not okay, because Jake in the warehouse is supposed to be managing operations of production. He's not supposed to have access to the payroll system. Are you with me? So we can look at that list and see, does that seem reasonable? Okay. Then step two, we can pick someone not on that list and we can ask them, Jake in the warehouse, go into the IT system and try to access the payroll function. And we would observe, right? So we would inquire of our client and then we would observe what happens when Jake from the warehouse tries to get, I feel like I'm saying Jake from State Farm. Jake from the warehouse tries to get into the payroll system. We can observe it with our own eyes and we can request that the client give us a screenshot so that we don't just see it with our own eyes, but whoever's reviewing our work, they'll be able to also see what we saw, because we can produce a screenshot of the computer system. Are you with me? By observing that access, we would be able to say, was Jake from the warehouse able to get into the payroll system? If the answer is no, good. He's not supposed to. That control is working. If he logs in and boom, there's the payroll system, that's bad, right? That control is not preventing unauthorized people from getting into that system. That would be a control deficiency. By gathering this evidence and performing these audit procedures, you are able to form a conclusion about whether that control is actually working. Are you with me? Okay, so this is the one that we didn't get to on Wednesday, related to inventory management, okay? So on an annual basis, a physical count of inventory on hand is performed, including reconciling the physical count to the accounting records, okay? So all manufacturing organizations perform this control, or they should. At the end of an accounting period, they should be performing a physical inventory count. It literally means they count the inventory that they have on hand, both finished goods, work in process, and raw materials. And then they reconcile the count that they physically, like people literally going around and counting stuff. Or in some cases, I think I mentioned before that the hot dog manufacturer that I was one of my audit clients, the raw materials were like raw pig parts. And they would have them in big vats and we would have to weigh them. That's how they counted the inventory, right? Gross, but it smelled like bacon, so it was fine. So they physically count work in process, raw material, and finished goods, and then they reconcile that to what's on the accounting records, okay? So you're the auditor. What do? Absolutely. Observe the client's physical inventory count. We make sure we have in our calendars, when do they do their physical inventory count? Not all of them do it right at the end of the year. Some of them may do it like in November, and then they do what's called a roll forward from the time they do the count to the end of the year to make sure that the inventory is still accurately being recorded, okay? So we put that in our calendar, and you, as interns or incoming staff, are going to be assigned to these inventories. They're not sending the partners out to count the pig parts. They're sending you, right? It actually was one of my more favorite things to do because you were out there physically walking around, talking to the people, figuring out how the inner workings of the manufacturing process operated. It was really, I enjoyed doing them, okay? But you will physically go out to the client's site and you will observe their physical count of inventory. You will walk around, talk to the employees, and see with your own eyes that they are performing that physical inventory count, right? And then you'll write up your observations typically in a memo, which you could even include as a step. We would include that memo in our audit work papers. On this date, at this time, we began our observation. We toured this part of the manufacturing facility. We went to this part of the storage unit. We had to put the garb on with the steel-toed boots and go into the freezer because some of those products were frozen. We had to go into the deep freezer and we counted some of those things and observed some of that counting, right? You would write that up in a memo to include in your audit work papers. Okay. Now, what about the second part? So we observed, we're walking around and we're just watching everybody else do the count. Okay. But what about the second part, including a reconciliation of the physical count to the accounting records? What would you do to make sure that that's happening? This is almost like a two-part control, right? Like one, they're doing a physical count of inventory. So what are we going to do? We're going to observe it. But two, then they're reconciling the physical count to the accounting records. What would you do for that? Yeah, Madeline. Absolutely. But not for every single piece of inventory, right? There's too much. We couldn't do that for everything. So we would select a sample of inventory items, and oftentimes they'll have them like in sections, or you know what I mean? They'll like categorize, okay, this is section 101, and we're going to count this section 101 and then reconcile it to the accounting records of section 101. So you could pick one of those sections, you would select a sample of inventory items and re-perform, because remember, they're supposed to have already done it. They're supposed to take the inventory count and reconcile it to the accounting records. So what you are doing as the auditor is re-performing what they did. Re-perform the reconciliation of physical count to accounting records. Okay, so two-part control means you need to do a couple of things. Not only do you want to walk around and observe that they're actually doing it, but by re-performing their reconciliation, you're making sure they're doing it right. You see what I'm saying? You're making sure that they're actually following through, because the whole point of this control is to ensure that inventory is properly stated in the accounting records. If there's a whole section of their facility that all of the inventory items have been damaged, right? Then what you should see in that reconciliation is that there is 0 in the physical count, and they've made an adjustment. So there should be 0 in the accounting records for that damaged section. If they can't sell that inventory, then that's not an asset anymore. It should be off of their accounting records as well. Make sense? Okay, so for Earthware's case study, you are going to do this exact same thing, except it's going to be all about the revenue process. What control activities does your client have embedded in their revenue process to make sure that they are preventing and detecting when misstatements would occur in the financial statements? They are making sure they are implementing these specific activities to make sure that nothing goes wrong, okay? And so you're going to be tasked with coming up with an audit program that goes step by step. What would the auditor do to make sure that the control is actually working? Okay. So before we get to that, let's familiarize ourselves with the revenue process. Okay. So in this first part of chapter 10, what we are going to discuss are the different transactions that go through the revenue process, the significant accounts that are affected by the revenue process. We're going to talk about the departments that are involved within an organization in the revenue process. We're going to talk about the documents and records. So we are becoming familiar with the revenue process. Now, I don't expect you to be an expert about the revenue process after this 30-minute lecture that we go through. Okay, so when you are working in your audit team on creating your audit program for Earthware's revenue process, have this up next to you. Because if you read a control that says the open order report is reviewed and reconciled, or et cetera, and you're like, what the heck is the open order report? Here's where you're going to get that reminder. We're going to talk about what that open order report is here in a couple minutes. But if you forget when you're in your audit teams working, this is your resource to go back to remind yourself, oh, this is what the open order report is, or, oh, this is what the credit authorization department is supposed to be doing. This is what their responsibility is, right? That's what this lecture is going to be useful for moving forward. Now, revenue. This should be familiar from financial and intermediate one. What are we talking about when we say the word revenue? It's defined as inflows or other enhancements of assets from the delivery of of products or services. So you provide a product or service to a customer, you earn revenue. But over the last 5 or 6 years, the revenue rules changed slightly. And the Financial Accounting Standards Board, right, the organizing body that creates generally accepted accounting principles, provided more details as to, okay, when should you record revenue in your accounting records? And they said that there are a few steps that you have to follow in order to ensure that revenue has actually been earned, okay? And again, these should be familiar from intermediate one. Number one, you should identify that there is an arrangement between these two parties, right? The supplier and their customer. Number two, you should be able to identify what are the specific things that the company has to do for their customer. Performance obligations. So with selling products, that becomes pretty simple, right? The performance obligation is that they deliver the product to their customer. That's the performance obligation. But what if you get into something like software development, right? So what if your audit client is in software development? What is the performance obligation? Well, they might have to implement the software in the organization, test it before it goes live, do updates to it on a periodic basis. Then there becomes numerous performance obligations. Again, we're not going to get into those sort of complicated things. That's what you talk about in intermediate one. Our performance obligation for Earthware is going to be very simple. They are a retail company and they will deliver their product to their customers, period. Okay. So we have to identify the performance obligations. We have to be able to say what the price, right? What is the value of the exchange? We should be able to determine that. And then we would have to allocate that price to each individual performance obligation. And again, for Earthware, it's going to be very simple. The price of the product is attached to the performance obligation, which is just delivering the product to the customer. Very simple. And then making sure that we only recognize revenue once the performance obligation has been met, the delivery of the product. Okay, so this is how the FASB has expanded on the rules related to revenue recognition. It really didn't change anything. It just provided more detail to organizations so that they understood how to go about accounting for revenue. Okay, so now let's get back into the auditor's perspective. As the auditor, generally speaking, not just for Earthware or not even just for retail clients, for all different kinds of clients that you may be working for, these are generally the most prevalent fraud risk factors that we would want to consider in our audit of the revenue process. These are the things, the most popular ways that organizations will commit fraud in their revenue process. And again, what we want to do as the auditor is just identify whether these are significant risks for our audit client. Okay, so let's talk about what each of these things mean. Side agreements kind of is what it says it is. Instead of applying a standard agreement that you have with the majority of your customers, you're cutting deals with other particular customers. You have side arrangements with other customers. Okay, that doesn't necessarily mean fraud is occurring, but it is an indicator that fraud could be going on. So if they have side agreements, we would just want to understand what are they. And then we can assess whether it goes to the level of, no, that's not appropriate. You shouldn't have those kinds of arrangements with your customers, or whether it's just sort of in the normal course of how the industry operates, that, yeah, that's an okay thing to do. Okay, so side agreements. And I'm going to jump down to number 3 for a second, because side agreements and related party transactions kind of go hand in hand. Oftentimes, if an organization has a side agreement with their customer, it's because that customer is a related party. Okay, I'll give you a for example. I think we talked about this before too. I am the controller, the accounting controller of Earthware, and my husband works in an accounting capacity at one of our biggest customers. That's a related party. Okay, now again, that doesn't immediately indicate that fraud is going on, right? But if I have special side agreements with that one customer, that could be an indication that we are not meeting those performance obligations the way that the revenue recognition rules say that we should, and that fraudulent activity is going on. Okay, so oftentimes side agreements go hand in hand with related parties. Again, what is our responsibility as the auditor? We would have to identify who the related parties are. So we would have to inquire of the client. We would inquire of the board of directors, specifically the audit committee, to get an understanding of any related parties that they may have in our current audit period. Okay. So jumping back up to number 2, channel stuffing. So channel stuffing is basically where we convince our customers to purchase way more than they could ever probably use. And the reason for that is we're trying to meet a revenue target within this quarter or within this fiscal period. And so we maybe cut a side agreement with them and say, hey, if you buy a whole bunch of product now, then we'll maybe cut you a deal the next time we have this arrangement. That's channel stuffing. So in no way would that customer ever actually buy that quantity of product, but we convince them to with some sort of side arrangement or blackmail it could come to, right? Channel stuffing. And then lastly, a bill and hold sale. So that's where, so if I'm Earthware and Tristan is one of my customers, I tell Tristan, hey, I know that you wouldn't normally order until next month because you don't have the warehouse space to store the product right now. So here's what we'll do. Send in your order, we'll process the order, but I'll hold it for you. So we'll make it as though you bought this stuff, but you don't actually have to store it yet. I won't send it over to your facility until next month. That's a bill and hold. And that goes against the performance obligation, right? I have to deliver the product to the customer before I'm able to recognize revenue. So that would straight up be fraud. That I have recorded revenue for goods that have not been delivered to the customer. Okay, make sense? So again, these are the things that we want to be aware of as it relates to fraud in the revenue process. These are the most common ways that fraud occurs within the revenue process. So we, again, don't always go into every client scenario with the mind frame that fraud's going on. We got to find fraud. We got to find fraud. But it's just, we have to have this sort of lingering in the back of our minds, because our primary objective is to form an opinion on the financial statements and the system of internal control. But we do have a responsibility to look for fraud in the normal course of our audit. That's not our primary focus, but we do, as the auditor, as the external auditor, have a responsibility to look for fraud as it relates to our general audit procedures that we're doing. Okay, so now let's talk a little bit about what goes on in the revenue process. 3 specific transactions that are processed in the revenue cycle, okay? The sale of goods or rendering of a service to a customer. So the sale of goods is what we're going to focus on for Earthware because they're a retail company. 2, the receipt of cash from customers for those goods that we rendered. And 3, the return of goods and our credit to that customer's account in the event that it wasn't what they ordered, the goods were broken, whatever the case may be, okay? So thinking about these 3 transactions, I want you to take this to the financial statements. take this to the journal entry that you would have to make. For number one, the sale of goods and services. What are the accounts on the financial statements that are going to be impacted by that transaction? You sell goods to a customer. What entry do you make in your journal? Right. What do we call credit? Accounts receivable. And then what's the, so this would be the debit, what's the credit in our journal? Revenue, right? Perfect. What about number two? Actually, I lied. Let's talk about number two. What would be number two? Your customer pays what they owe you. What's the entry you'd make in your journal? Yep. And then what about number three? This is a funky one. So let's say those goods were sold on credit. That means we would have used accounts receivable. So it would have been debit accounts receivable, credit sales revenue, but then they give them back to us. Yes, inventory, but we don't focus on the effects of these transactions in this process. We focus on the effects of inventory transactions in the inventory management process. So you're absolutely right. But in the context of the revenue process, the accounts that would be affected here are sales, returns. You remember that? Sales, returns, and allowances. It's a contra revenue account. Okay. And then the credit would be to accounts receivable. We give a credit to their account. They no longer owe us that amount because they sent it back to us. Okay. Now, I want to expand a little bit on number one and a little bit on number two. On number one, what if we give them a discount? What's the account name that we would use in our journal when we give the customer a discount? I know this is, you guys are like pulling way back from financial accounting. Don't think too hard. Kind of like this one. Sales discount, right? So what we might add to this one is sales discount, right? If we give the customer a discount, we would take that amount off of the total amount that they owe us, but we would still record the full sticker price as revenue. This becomes a contra revenue account, just like this sales returns account. Okay. And now let's expand on number two. Is every single customer always going to pay you 100% of what they owe you? No, they are not. And so we have to account for that because the matching principle says, again, we're pulling way back from chapter 1 of financial accounting. The matching principle says that you have to record expenses in the same period that you generated revenue. So we have to estimate what is the expense that we would incur when a customer doesn't actually pay us what they owe. Do you remember what that expense is called? Rent, maybe? That's right. Bad debt expense. So if we are making an entry at the end of our accounting period for our estimate of bad debt expense, we would debit bad debt expense. And do you remember what the credit would be? It's a contra asset account. It goes against accounts receivable. Yeah, that's right. Allowance for doubtful accounts. DA, doubtful accounts, allowance for doubtful accounts. You guys did a lot better with that than I thought you were going to do. I just know that sometimes if you haven't heard this in like a year and a half, it kind of can be a little bit like, holy crap, I don't remember that. Very good. Okay. So also, all of those answers are on the next slide. But I want us to brainstorm about them a little bit so that you can see these are things that you remember. These are things that are familiar to you. Okay, so our revenue process is impacting all of these financial statement accounts. Okay, now when they say trade accounts receivable, what they mean is the everyday accounts receivable that you're used to making entries for in your journal when you're in financial accounting. But you may also recall from financial accounting that if we make our customer sign a contract, we give them a little bit longer period of time to pay us, and we charge them interest, we would have a note receivable instead of just a regular old account receivable. So that's why this says trade accounts receivable, because there's also notes receivable, but we're not going to discuss that in this particular cycle. Okay. So we understand what kinds of transactions are going on in the revenue process. We also understand how or which financial statement accounts do those transactions have an effect on, right? When we process the sale of a good to a customer, what's the entry that we make? When we process that the customer sends us merchandise back, what's the entry that we make? When we estimate how much are we actually not going to get from those customers, what's the entry we make for that? So that's what this exercise was about, is understanding what are the financial statement accounts that are affected by the revenue process, okay? Let's then move on to understanding, again, this is not something that you should memorize. This is not something that I'm even going to put as a question on a test. This is meant to be a resource for you in completing your audit of Earthware's internal. A credit approval form is needed for all new customers. And you ask yourself, what the heck is a credit approval form? You can come to this PowerPoint and read the definition of what is that document, okay? So a credit approval form is being used to authorize the sale of goods to a new customer. So it's going to identify essentially what the credit worthiness is of that organization, of that new customer. The customer sales order is the order that they send to Earthware that details out what products are they requesting, what's the quantity of those products, when do they expect to receive them, when was the order placed. It's going to have all that detailed information in it. The open order report. So let's say that Earthware receives a whole bunch of orders through the month of September, okay? At the end of September, some of those orders might not be filled yet, right? Why might they not be filled yet? Why hasn't Earthware filled those orders for their customers? Well, depending on the terms, if they require payment before delivery, yes, absolutely. That's one reason why the order might not be processed. Another reason why the order might not be processed, maybe Earthware didn't have the finished goods yet, right? So just a time lag. But Earthware doesn't want those orders to just fall into a black hole and never be filled, because then that means they're never going to be able to record revenue related to those orders. So on a periodic basis, they'll create a report. Here's everything that's open right now. If it's closed, that means the goods have been sent to the customer. Done. If it's open, that means we have the customer's order, but we haven't sent them anything yet. Or maybe we could only send them a partial order, right? Maybe they ordered 2 or 3 different products and we only had 2 of them. So we sent those. So we have a partial order that's still open. Regardless, Earthware would want to review that on a periodic basis so they can ensure that they are closing out those orders and are able to generate the revenue from those orders. Okay, open order report. Other documents and records used in the revenue process. A shipping document. You can oftentimes see this referred to as a bill of lading, and it's all just going to contain, here are all of the items that are currently being shipped. Now, all of the items that are currently being shipped should be the same as the items that you saw on the order, right? The customer sends an order and then you're going to ship them goods. It better be the same goods that they ordered, right? Even if it's a partial shipment, it should still be those goods that were on the order form, okay? And the same thing with the invoice. So the invoice is essentially the bill that Earthware is going to send to their customer. And again, what they bill the customer should be equal to what they shipped the customer, which should be equal to what the customer actually ordered. Those things should all be the same. What they billed them, what they shipped them, and what the customer actually ordered should be the same. And then you learned a little bit about special journals in financial accounting. We talk about the fact that if a transaction occurs very, very frequently within the organization's accounting system, they will often use a special journal. That's keeping track of just the sales transactions, right? And then at the end of a period, they will take the cumulative amount of that special journal and they'll put it into their general journal. They'll make an entry, like a summarizing entry, into their general journal, okay? So the sales journal is just going to be every entry that they made to sales revenue. So every credit, where is it? Every credit that they made to sales revenue over the given period of time. That's what the sales journal is going to include. A customer statement. So I will be very clear that Earthware does not use a customer statement, okay? Some of these documents and records may not be relevant depending on what kind of client you're working on. Earthware simply doesn't choose to use a customer statement. But a customer statement is basically at the end of a period, whether it be a month or a quarter or whatever it is, the client, Earthware, would send their customer just a summary. Here's everything that you still owe us, right? If there were multiple orders placed within a given period of time. But from our perspective, when you're looking at the case study for Earthware, you will not see mention of a customer statement. Earthware doesn't use them, okay? We also, in the same context that we talk about special journals, we also talk about subledgers. And when we talked about subledgers in financial accounting, we talked about them as T accounts, right? Every time you made an entry in your journal, you had to update the specific T account for that same information. And each T account is just accumulating all of the debits and credits that have happened to one particular account. So as it relates to the revenue process, that particular account is going to be accounts receivable. We can use that subledger to just see all of the debits and credits that have occurred during our period of time to accounts receivable. A remittance advice. So again, all of these, by the way, don't have to be hard copy documents or forms. A lot of the times they're going to be electronic. The evidence that you gather from your Earthware client in the second phase of this case study is all going to be electronic. And you're going to document it all on your iPads using your little Apple Pens and stuff. I'm going to teach you how to do that when we get to the point. But a remittance advice is usually a part of the bill that the customer would send back with the cash that they're using to pay off that bill. So it again summarizes, here's the invoice that this particular payment should be applied to, a remittance advice. A cash receipts journal, again, same as a sales journal. As we see cash coming in and out on such a frequent basis, we can use a special journal to track it. And then a credit memo. So that's down here. When the customer returns merchandise, we would issue a credit memo. That should show that they no longer owe that amount, right? That should reduce their overall accounts receivable, okay? And by the way, if they already paid, let's say the customer already, right? We recorded accounts receivable, credit sales revenue, but then they paid debit, cash, credit, accounts receivable. If we issue them a credit memo, we could potentially put their accounts receivable in a credit position. We know that that's not usually the case. Accounts receivable as an asset is usually in a debit position. But if we issue them a credit memo, essentially what we're saying is they have a cushion in their accounts receivable. They can buy a little bit of product and they wouldn't owe us any money because they already paid us for some of the goods that they then returned. So we're giving them a little bit of a cushion with a credit in accounts receivable, okay? So credit memo, and then this last page, an aged trial balance. This is what you did in the IDEA homework in chapter 5. You went through and you were able to take all of their receivables and you were able to categorize them as these receivables aren't due yet, right? These receivables aren't due yet. Then here's a bucket of receivables that are 30 days overdue. Here's a bucket of receivables that are 60 days overdue, and so on and so forth. So you did that in the IDEA software. You're going to see it again in the test of controls for Earthware, because Earthware should be creating an aged trial balance and using it to calculate their bad debt expense on a periodic basis. So you're going to revisit that. And then if a customer is deemed to be, or if the situation is so that the customer, we know 100% they are not going to pay us what they owe us, we would not want to keep that account receivable on our accounting records forever. We know they're not going to pay us. We would want to make an entry in our journal to remove that receivable from our accounting records. We should get authorization to do that first. We should get some form of supervisor approval before we write off. That's what that means. Write off our accounts receivable. That means make a journal entry that's going to take that accounts receivable and wipe it from your accounting records. There should be some form of authorization before that's done. Okay. All right. Documents and records that you again may see described in Earthware's test of controls. The major functions. So these are the departments that are going to be involved in the revenue process for Earthware. Okay. Order entry, credit authorization, the shipping department, billing department, cash receipts department, accounts receivable, general ledger. And these departments may not necessarily be actual physical departments. They may be IT systems, right? So for instance, a lot of the times the general ledger function is just completely IT based. It's automatic updates to the general ledger system based on data that's being fed from other programs. Okay, so it doesn't necessarily mean that it's a physical department with personnel in it, but it could also be just completely IT based. And then finally, what are the kinds of responsibilities that we would want to see separated in our revenue process? So this is part of what we would like to see going on in the revenue process's internal controls. They should be separating things like the person who does the credit check should not also approve the customer order to go through the system. It should be two separate people, that a credit check is done independent, and then that credit check is used by a separate function to process the order. Okay. There should not be one person that is able to access the customer's cash payment and also access the accounting records, because they could steal the cash payment, make a journal entry to cover it up. Okay, so generally speaking, these are the kinds of functions and how they should be separated within the organization's revenue process. Again, use it as a resource as you think about how these controls should be functioning in your Earthware case study. Okay, so you will recall this outline from Chapter 7. This outline provided us with the blueprint that the auditor follows in order to conduct their test of controls. Okay, what we are assuming in our case study is that the planning and the selection of controls to test has already been done. So we have already planned for our audit. We know which locations we're going to audit. We know which business processes. We know whether we're going to use internal audit as a function or not. We know all of that. That's our planning. What we also did was walk through each business process. And again, the one that we're focused on is revenue. And within that process, we were able to find where are there points where something could go wrong in this revenue process. And then what controls does Earthware have in place at those points where something could go wrong? That has already been done. Okay. And where that leaves you is with evaluating the effectiveness of those controls by testing whether they're working or not. Gathering evidence, performing audit procedures so that you can conclude whether those controls are actually working. In order to plan your test of controls, some of the more common audit procedures that you will conduct, and we talked about these again in Chapter 5, you will inquire of your client about different things that are going on, different activities. You will inspect records and documents. You may observe a control activity taking place. You may re-perform something about that control activity that Earthware has already done. And I didn't highlight walkthroughs because a walkthrough I mentioned last time, a walkthrough is basically where we take one transaction and we follow it from start to finish. And that's, again, we're assuming that's already been done. We've already done that because then that helped us identify what controls do they have in every phase of the process. We've already done that. So that's why walkthrough isn't highlighted on this slide. Okay. So your case study for Earthware is available to you in this assignment. So in Moodle, if you click on the Earthware Test of Control Audit Program Draft Assignment, you should see an Excel spreadsheet, okay? And I've included a list of requirements, but I'm going to walk you through that right now. I'm going to walk you through what my expectation is right now, okay? If you open that Excel spreadsheet, it will look like this. You will notice that on the bottom, each tab is labeled by department. So if you click on the Order Entry tab, what you are seeing are controls that should be going on in the order entry function of the revenue process, okay? So each department is represented by each one of these tabs. Your audit team is responsible for every control that is bolded. And you will be reminded that those are the ones you're responsible for because the other controls that aren't bolded already have steps on them. You don't have to do anything for those. What you're assuming is another part of your audit team has already created the program for those controls. Your team is responsible for the bolded controls. There are 6 of them, okay? So there are 2 order entry controls. There are 2 credit authorization controls. There is 1 accounts receivable control. And there is 1 returns and allowances control. 6 in total, okay? Your audit team is responsible for the following. Number 1, identify what could go wrong if that control wasn't working, okay? So you are just going to type right underneath the description of the control, your audit team's conclusion. What could go wrong? What could create a misstatement in the financial statements if that thing wasn't happening, okay? I'll give you a for example that doesn't relate to revenue. We just finished that exercise where we went through the inventory control, right? And that inventory control said that on an annual basis, the company performs a physical count of their inventory and they reconcile that to the accounting records. What could go wrong in the financial statements if they're not doing that, right? Inventory would be misstated because they could have obsolete or damaged inventory or stolen inventory, right? That still shows up on the accounting records and it's actually not even in the facility. That is what could go wrong. Do you understand what I'm saying? What could go wrong if that activity is not actually happening? That's the first thing that you're going to do. Then the second thing that you're going to do is create an audit program that outlines what does your team think you need to do in order to make sure that that control is actually working. And that's similar to the exercise that we just finished up at the beginning of class. You're going to create steps, right? And the way that it's formatted on the other tabs for the controls that aren't bolded, you can see it's A, B, C. If you guys want to do 1, 2, 3 or step 1, 2, 3, or stick with ABC, I don't care. Be consistent with how you format it for your 6 controls. Be consistent, but you don't have to do it exactly like this, ABC, okay? So you are going to identify what kind of evidence do you need to gather from your client, and once you have that evidence, what are you going to do with it? Are you going to inspect? Are you going to observe? Are you going to re-perform? Do you have to inquire? What are you going to do about it? Okay. So for those 6 controls, what you should submit by class time on Wednesday is 1, an identification of what could go wrong if that control isn't working. And that would just be 1 sentence that you would write underneath the control description. And then 2, for each bolded control, what are the steps that your audit team wants to take to test that that control is actually working. Okay. Now, I am not only grading this, assessing this on the accuracy of your steps that you come up with. And by the way, there's not a one-size-fits-all answer. Okay. Your audit, each audit teams is not going to look the same, and that's okay. Okay. But at its core, it should all be trying to accomplish the same thing. Testing that that control is working. Okay. So what I will be grading on, in addition to just have you identified steps that would allow you to conclude about the control, I will also be grading on your writing. Again, it doesn't have to be perfect, but you should be writing in complete sentences in a professional tone. That means using those verbs that we talked about in chapter 5. Inquire. Don't say ask, say inquire. Don't say I'm going to redo the reconciliation. Say I'm going to reperform the reconciliation. Use the terminology that we're becoming familiar with. And again, the resource that you can go back to is our chapter 5 lecture. It has all of those verbs that we discussed as here are the types of audit procedures that we perform. Okay. Do you have any questions? So everything that I just said out loud is written in the assignment description as well. Okay. So if over the weekend your team is working on this or you've divvied it up, P.S. I highly recommend that even if you divvy up, you come together to make final revisions, because I'm also going to be looking for consistency. I'm going to be looking for consistency in how you create these audit steps. Okay. So again, if your team over the weekend has certain questions, the first thing you should do is go look at the assignment description, because everything that I just said is in the assignment description. You can also reach out to me. The entire class period on Monday is dedicated to working on this. Okay. I will be here from 10 to 11:20 like I normally am. And your team is welcome to come in and ask me any questions or get any feedback on what you've got started so far. Okay. And it will be due by class time on Wednesday. Everybody cool? Okay. So our guests should be here. I'm going to go check if you guys want to. I didn't get that. Oh, for crying out loud. If